Hello, I'm Will Fleming, Manager of Financial Planning at Cambridge Trust Wealth Management, a division of Eastern Bank. Charitable giving can be an impactful part of wealth management. Today, I'd like to discuss the methods and benefits of making it a part of your financial plan. When planning to give to charity, the first step is to create a charitable mission statement based on your core values, personal experience, and interests. This is typically a few sentences to help define the purpose of your giving and to make it more meaningful for the communities you support. Narrowing down which organizations you want to support is a big decision. You should consider whether you want to support causes in your community or state, or causes that reach a national or international level. Evaluating the effectiveness of the charity is also very important. For transparent organizations, impact information will be publicly available in their annual report and shared in their newsletters and website. Once your mission statement is clearly defined and you have identified the organizations to support, there are 4 common giving strategies to consider. The most common approach is donating to a charity directly. The IRS defines a 501c3 charity as an organization operated exclusively for exempt purposes outlined in Section 501c3 of the Internal Revenue Code, and none of its earnings may vest to any private shareholder or individual. In addition, it may not attempt to influence legislation as a substantial part of its activities, and it may not participate in any campaign activities. When donating directly, there are limitations on how much you can deduct from your adjusted gross income, or AGI. For public charities, deductions are limited to 30% of AGI when donating appreciated securities, and 60% when donating cash. For donations to private foundations, deductions are limited to 20% of AGI for appreciated securities, and 30% for cash. Donations above these limitations may be carried forward subsequently for 5 years, but keep in mind your ability to itemize deductions may be subject to other limitations. We recommend working with your tax advisor to determine your tax deductibility status. For IRA owners, having to take a required minimum distribution can create large tax burdens, as money distributed from IRAs are includable in taxable income. This could push taxpayers into a higher income tax bracket. Those who don't need this money to support income needs in retirement and wish to reduce their income tax burden may consider a qualified charitable distribution, or QCD. Currently, a QCD from an IRA allows you to distribute up to $108,000 directly to qualified charities without including the distribution in your gross income. This strategy may also reduce required minimum distributions in future years. QCDs are not counted towards the maximum amounts deductible, potentially allowing donors to give larger gifts than if they had donated cash or other assets. While the beginning date for required minimum distributions has shifted over the years, individuals can take advantage of QCDs as early as the year in which they turn 70 and a half. A donor-advised fund, or DAF, is a charitable giving vehicle with a give, grow, grant framework. Donors can target the amount they contribute to the DAF and can generally take a charitable deduction for the tax year in which the contribution was made. Contributions can be made in cash, appreciated securities, private business interests, or private company stock. Donors can grow these assets tax-free over time by choosing investments in the DAF. They can then direct which qualified public charities receive funds from the DAF at a pace that is comfortable for the donor. AGI limits on charitable deductions do apply. Finally, a charitable remainder trust, or CRT, is an irrevocable trust that can provide a potential income stream to the donor or other beneficiaries. The remainder of the donated assets will go to the charity at the end of the specified term of no more than 20 years or the lifetime of one or more of the non-charitable beneficiaries. A CRT can address concerns around retirement income, estate planning, and tax management. This split interest giving vehicle allows you to take a partial income tax charitable deduction when you fund the trust, which is based on a calculation of the remainder distribution to the charitable beneficiary. Cash, appreciated securities, real estate, private business interests, and private company stock can be donated to a CRT. However, it should be noted that CRTs cannot hold S-Corp stock. Navigating today's shifting landscape can be overwhelming. That's why Cambridge Trust Wealth Management is here to help guide you on your philanthropic journey and provide you with peace of mind. Our experienced team can help you land on the right charitable giving strategy to fit your philanthropic goals and reduce tax liability, so you can achieve a deeper involvement in advancing the initiatives that you hold near and dear. Stay up to date with today's wealth management strategies by discovering more insights at cambridgetrust.com.